We're glad that you're here with us on this Monday, being a part of the RFD TV and Rural Radio family. John Jenkinson with you. Let's go straight to the corn market. We did see this whole entire grain complex start to soften a little over an hour ago. Right now, we've got the corn market for December down 1 1/4 at $396.5. The far out September is down a penny at $406 3/4. So not only is the corn market kind of quiet, it's pretty consistent all the way across the board. November soybeans up 4 1/4, 9.40 1/4, a dime, almost a dime off of the low. The July is up 2 3/4, 9.79 1/2. Over in the wheat market, December Chicago wheat, the nearby, up 1 1/2, 5.09 1/2. But that new crop July steady, 5.22 1/4. Kansas City wheat for December up 5 1/4 at 4.24 3/4. The new crop July up 3 1/4 at 4.54. Keep in mind that this Kansas City wheat market has been kind of the strength that the rest of the grain complex has been kind of leaning toward here today. Let's visit with Todd Horwitz with Bubba Trading as he joins us now from his studio there in Redwood, Illinois. Todd, it's good to talk to you today. I want to get your thoughts. What are you hearing? What's your opinion now that we have this quote-unquote partial agreement and how it factors into these markets here today?
Good morning, John. You know, this is laughable. The deal was a no deal, okay? Again, this is going to come down to two things. The two presidents, President Xi and President Trump, have to both come out looking like they won. And to me, this was the big anticipation turned out to be a big nothing. But of course, the grains have actually priced this almost perfectly the entire time. And they were higher on Friday, which we thought after that ridiculous report on Thursday. And of course, this morning they were a little bit higher and they gave away a little bit earlier, but they still look pretty good. Again, they're breaking out. They're in really solid technical shape that look like they want to go a lot higher. So trade deal, no trade deal. The grains look like they're going higher, and the trade deal itself was really nothing. Okay, like it's a big soap opera, I guess I'll call it.
Okay, so if you're a producer and you're trying to get this year's harvest out of the field right now, or maybe if you're done already, you've got some grain in storage, what's the next step then here? Because if this market continues to slowly grind higher, there's still a lot of folks talking about that January crop report really causing this market to really be surprised maybe and go up higher even from there. So strength between here and there, or do we just kind of trade sideways?
No, I think there's going to be a lot of strength. I think there's going to be a lot of surprises, you know, from the YZ report we got the other day. I think that it was totally wrong. I mean, I don't read them, but I thought it was totally wrong. I mean, I think there's a lot of problems, and everybody I talk to says that some of them can't even get into the field to get the harvest going, let alone the damage. I'm hearing guys are only going to be able to produce 75 to 80% maximum of what they projected they were going to produce. So I think when you talk about your question, what should they do, it depends on what your basis was. If you can get out at profits right now, and lock in profits, I would certainly do that. But I always believe in hedging it so that you can protect the downside while leaving the upside wide open. So if you want to hold back for price, just learn how to hedge and be able to protect it down while you're still having the full run to the up instead of giving up the upside.
What about the fund managers? You think they're looking more and more at the grain complex to get back in the game?
I think they've been trying to sneak in here. I think that part of the reason I think we started to rally earlier was they're trying to buy out all those shorts they put on, and they're kind of getting trapped, and they don't want to create, you know, a basic run and push them up too high too fast, because obviously they'll have to pay for them. But I think they're getting in, and I think, as we've said, that this is the place to be right now. There's no better place in the ag space to put money right now as far as I'm concerned.
Todd, I know that you grew up in the protein complex. We're going to come back from the break and visit with you about what your thoughts are over there. A big lot of strength, in fact, over there in that cattle market. We'll get to that next here on the Market Day Report. In just a minute, we're going to go back to Redwood, Illinois, and visit with Todd Horwitz about this protein complex. First of all, let's go to the cattle market, see if we're still putting some gains on over here in the fats and the feeders. First of all, the October live cattle now up $1, 110.45. We've been hovering above this 110 for a good part of the session. December up $1 and a nickel at 113.20. The February up $1.03 at 119.08. Yeah, we did have higher cash trade back on Friday. It was a moderate movement too. November feeders up $1.88 at 146.13. January feeders up $1.83. They're at 142.30. Now the pork complex is a little different story here today. We've got the December off 47 at 69.13. The February down 10, but those far out deferreds of April and May are actually on the higher side. Todd, is this pork complex reacting the way you thought it would now that we have this quote unquote this partial agreement that you and I talked about?
Well, John, I think they overpriced in the agreement, which is why we've kind of stalled the last couple of days. I would expect if they can't get through back 70 basis December, I would expect to see a fairly decent pullback, probably down to about 65. But you can see that once we get through December, you're seeing higher prices, which makes sense. I mean, that is the normal formation anyways, that we do get higher prices going into February and going out to April and so on and so forth. So I think that if they can't get through 70 here, which they're really struggling trying to get back through there, I think it's probably back down to about 65, and then they can probably take off again. But I think there's some work to be done here, and I think they overpriced what was going to be done by China here.
What I find interesting, too, is about 6 weeks ago, you and I were talking about this cattle complex and how it certainly looked like it was going to come back. You've been saying that all along, and look where we're at. We're trading cash at 109, a solid 109. We had moderate movement. Now we've got the live cattle futures, at least that October contract, at a premium to the cash. It looks like all the stoplights are green through all of these intersections here that this cattle market has to go through.
Just step on the gas, baby. We're going higher. I mean, again, could there be a slight pullback? Of course. But I think you're going to see, look, I'm looking for 115 as my next target here. We've done all the technical work we need to do after the Tyson fires and back and filled up these gaps. From a straight looking at the price action, which is all I care about, the markets look like they want to go much higher. They're in extremely bullish formations. So I'm looking for 115 in December cattle, and I'm looking for 150 in feeders. So I think they're all going up higher, and we'll see where we can go from there. But those are my next targets where I'm looking for. I never like to get too far ahead of that. That would be my next look where I can see us going to from here.
All right, what about crude oil? You and I have had many discussions about this. We're a little bit weaker here today to start the day. In fact, we pulled that heating oil back 5 pennies. We're down a little over $1.50 a barrel on crude. You think we'll go back down here and visit the upper 40s?
I think maybe now we got a chance to go into the lower 40s now. I think it doesn't look very good. You go back to 3 weeks ago today, I think it was with Saudi Arabia. We had that major spike to the 60s, and here we are in the low 50s. We've already tested 50 once. I think we can break that through. You're going into the 40s. And look, there's so much supply. The worldwide economy is slowing. There's not as big a demand for any number of reasons. But the number one is there's so much supply. How are we going to use it all? And if we keep getting more fuel efficiency, I'm looking for much lower prices. That could change. But for today, I'm still looking to see in the 40s before it's all said and done.
And you see that as a buying opportunity once we would get into the 40s then?
No, I don't think so. I mean, I think crude's got a chance to go significantly lower over time. But I don't like to make those long outrange calls that are outrageous. Right now, I can see the high 40s based on the work that I do. And again, depending on how it acts there, you could see back in the 30s again at some day. But again, I don't want to make that call, nor do I want anybody to try to trade or invest or protect off of it. But right now, that's how I see it. I think we could see a lot lower prices as the frackers continue to put oil out.
Okay, Todd, thanks a lot. Todd Horwitz, Bubba Trading there in Redwood, Illinois, just outside Chicago. Tammy, that's kind of where we're standing with the markets now.
All right, thanks for keeping us updated, guys.
Yes, ma'am.